Good afternoon, we are Team AO and today we'll give suggestions regarding Alrosa. To start with, we make a recommendation buy for Alrosa, which is listed at 90.37 rubles per share with a target price of 109.95 rubles per share using DCF and DDM valuation methodology. The target price is derived as the arithmetic mean of the results obtained from the DCF and DDM models. The forecast implies a 22% upside movement in the price. We are positive on Alrosa's ability to deliver a strong free cash flow in 2020 till 2022 due to market stabilization, capital expenditures reduction, stable dividend policy, and healthy financials that aim at maximizing shareholder return. Alrosa is an exporter of rough and polished diamonds, microgrids and cut diamonds that are 83.29% of revenue. The company's management board in reports identifies the following sectors: transportation services, which include airline business, terminals, ports and airports that are 8.6% of revenue, social infrastructure, houses, sports complexes, cultural facilities, which account for 1.77% of revenue, and other activities, which are 6.34% of revenue. The strong balance between company's cost and quality allows it to consistently outperform its competitors in terms of sales of rough diamonds.
In 2018, diamond sales had the largest share in the company's revenue structure, more than 94%, then transportation with 2.86%, while other and social infrastructure revenues does not exceed 3%. From mining to sales to end users, diamonds pass through several segments. Mining operations involve exploration, mining, processing as well as initial sorting of diamonds, and is characterized by the highest operation margin of the chain from 16 to 20%. Three countries, Russia, Botswana and Canada, account for 65% of world sales in terms of value. Cutting and polishing is represented by hundreds of large and small businesses, which have traditionally been concentrated in Belgium, Israel, Russia, US, India, South Africa and Southeast Asia. After the acquisition of BHP Billiton's diamond assets by Dominion Diamond in 2012, the number of key producers in industry dropped to 4. Apart from Alrosa, major producers include De Beers, Rio Tinto and Petra Diamond. The largest share is held by Alrosa, 27%, then De Beers with 24%, Rio Tinto with 12%, and the share of Petra Diamond does not exceed 3%.
As luxurious diamonds directly depend on personal disposable income, which can be tracked through GDP growth, in 2020 and 2021, the IMF expects world real GDP to grow by 3.4% and 3.6% respectively, with emerging markets as the main contributors. The long-term target for annual percentage change in the world output in real terms is 3.6% on IMF estimates. Increasing wealth should continue to support demand for diamonds, especially in China and India, where higher PDI will be accompanied by rapid growth in the middle-class demographics and deeper penetration of Western consumer habits. The target audience for diamond products is the middle class. The countries with the highest annual growth rates of the middle class are China and India. However, the share of the middle classes and urban residents in the total population is still at low levels. Therefore, there is great potential for diamond sales to rise. We model the middle classes of China and India to expand by 10% in 2013 and 2025 to reach 44% and 46% of total population respectively. As for urbanization, over the past decade, the share of urban population in total increased by 4% and 2% in China and India respectively. We expect this dynamic trend to continue and be an additional factor boosting the demand.
The financial analysis section contains financial performance indicators, DuPont analysis, operating efficiency indicators, shareholder indicators, analyzing the data obtained on the return on assets and equity. We see that in the period 2014-2015, there was a rapid growth of these indicators. However, since 2016, ROA and ROE values have stabilized and remain among the highest in the industry. Analyzing the value of Alrosa's main cycle, we know that this financial indicator is in the negative zone for the entire period, which is a very strong advantage of the company. Thus, a negative cash cycle shows high efficiency of the company's asset management. As can be seen, the significant improvement in the financial leverage indicator from 1.83 in 2014 to 0.58 8 in the forecast period indicates a significant work of management to reduce the debt burden of the company. Analyzing the results of the EPS indicator, we see that in 2014-2018 there was a significant increase in earnings per share due to the growth in the cost of raw materials. Since 2018 there has been a significant decrease in this indicator and its stabilization in the range of 9 rubles per share, due to a drop in demand for diamonds and subsequently a drop in their price.
We forecasted Alrosa revenue for each of its segments by projecting the volume of diamond sales. The sales forecast was estimated using a regression model with seasonality factor. The other segments of revenue were estimated as a ratio of diamonds revenue due to its low value relative to consolidated revenue. As was stated, Alrosa maintains capital expenditures will decrease to 15 to 18 billion rubles by 2023. We estimated smooth decline rate of 13% and calculated the quarterly value of capital expenditures. As was stated by Alrosa management, the target value of multiplier net debt to EBITDA is 0.7. Using this assumption, we estimated the company's debt value. Since Alrosa operates globally and is also exposed to state-of-world major markets other than Russia, we apply major market CAPM adjusted by country risk premium. Alrosa's bet is derived from regression analysis by using weekly stock returns and IMOX as a benchmark starting from year 2016. Major market risk premium is set at a level of 4.24%, calculated using IMOX return. Adding country risk premium of 3.06%, calculated by Damodaran, to consider exposure to Russia economy risk results in a cost of equity of 13.54%. We arrived at a weighted average cost of capital of 12.72% for Alrosa, with our cost of debt 7.23% and our cost of equity utilizing a leveraged beta. To forecast the value of dividends, we estimated free cash flow that is the base of dividends value calculation. Free cash flow is calculated as subtracting the value of capital expenditure from CFO. According to Alrosa dividend policy, the value of dividend is calculated based on multiplying net debt to EBITDA, and the minimum value is set at the level of 50% of net income calculated by IFRS. Using all necessary assumptions, we forecasted the dividends value. For both methods, DDM and DCF, we estimated terminal value using average industry multipliers due to the fact that diamond sector stagnates, and using the terminal growth rate may give us biased results. We used enterprise value to EBITDA multiplier in DCF model and price to earnings in DDM. We combined the result of DDM and DCF analysis and arrived at our target price of Alrosa 109.95 rubles per share, a 22% upside from Alrosa closing price of 19.37 rubles per share on January 15, 2020.
There are different types of risks. Market risk. There is risk of further invention of synthetic diamonds, which will affect their demand for natural diamonds. In our opinion, the risk from synthetic diamonds can only be considered in the medium term, since the need for natural diamonds will remain in the long term. At the moment, they can hardly squeeze into the jewelry market because their value is belittled by jewelry houses. Geopolitical risks Angola. It's possible that the plan is not fulfilled according to the agreement between Alrosa and Angola and Diamond Mining on the creation of the Lux International Enterprise for the development of the diamond deposit of the same name in Angola. Geopolitical risk devaluation of the yuan. Further devaluation of the yuan threatens that the purchasing power of tourists from China to the United States decreases, which in consequence will lead to a decrease in demand in the jewelry market. Reputation risk. A reputation threat can occur due to accidents that can affect the environment because of political events. Management decision risk. There is a risk of making an incorrect management decision and failing to achieve the set goals.
We estimated the three ways Alrosa might develop by changing the forecast value of diamond sales and its prices. We got the values of DDM and DCF model for all the scenarios. Optimistic and realistic ones showed the 40 and 22% upside. Pessimistic scenario resulted in 2% downside. We also ran a sensitivity check to estimate the impact of change to weighted average cost of capital and the effect of change to multiplier used in terminal value calculation. Our testing was done using the realistic scenario. We note that in DDM analysis, our price to earnings value should decrease by 1 to motivate us to change our recommendation to hold from buy. In our DCF model, multiplier enterprise value to EBITDA should change by 1, or weighted average cost of capital should increase on 2% to change our recommendation to hold. Also, the parallel decrease in enterprise value to EBITDA on 0.5 or 1 and increase in weighted average cost of capital on 1% or 2% will make us change investment recommendation.